this is the chart of the Russell. Now, I've been very crystal clear. And by the way, one of the titles for this show today was talking about a credit event. And you cannot deny that we now have a $33 trillion basically debt for the U.S. We crossed 33 trillion. That is insane. All right. And the fact of how fast it's going up is remarkable, remarkably scary. Okay. So what we see here is 33 trillion in debt. The consumer is 1 trillion in debt just on credit cards. We have credit, we have defaults rising substantially above decade highs for credit cards as well as other loans, right? So defaults are rising. The housing market's at a standstill. Banks are struggling because they bought all these bonds that were paying 2%, and now interest rates are higher. People are taking their money from these banks and putting them into money markets to get 5%. So the banks are struggling. Essentially the criteria for the underlying economy, which has been built on a house of cards. And by the way, a Ponzi scheme is essentially what it is. It is borderline breaking down. Now, a lot of people will tell you that the massive collapse will happen very soon. I'm not necessarily in that camp. I think that there's enough fuel in the tank for the Federal Reserve that they can still plug holes for the time being. But there is little to no question in my mind that eventually we will see a major credit event that creates an epic collapse, and essentially we're all going to pay the price for that. By the way, I'm talking globally. You know, the U.S. has a credit event. It's not like Japan's not going to be influenced. It's not like China or Europe or the UK aren't going to be influenced. Everything is going to be influenced because, again, whether we like it or not, everything kind of takes off of the United States. It's still kind of the best house on an ugly block, if you will. All right. So what I want to show you here in the Russell chart, we have a classic, essentially wedge pattern. Now, this is a far cry from what we see on the QQQ. If we look at the Qs, right, okay, the Qs have had this big move up, all right? Now, the Qs, by the way, look at this. We're starting to hammer that lower trend line as well right over here. In fact, we talked about a shorter-term wedge pattern that actually broke yesterday. But again, it's looking like the big cap tech stocks, the Apples are starting to lose their luster, the Nvidias and so on and so forth. But my point is this. We know that the Russell is the best gauge of the overall economy. Why? Because it's 2,000 stocks. So the Russell is made up of 2,000 stocks, okay? While the NASDAQ 100 is just 100 stocks, and the S&P is just 500 stocks. Now, again, the Magnificent Seven, they are a huge influence on both of these because the multiple trillion dollars that they are, it's only based on 500 stocks. This, which is the Russell, the IWM, is 2,000 stocks, and it doesn't include the Magnificent Seven. So the reason why this is important to look at is because it gives you a much purer vision of what the economy is doing. How is the market really doing? Don't give me the put on these fake glasses view of the Magnificent Seven and their influence on the markets. Show me reality. And what we see is a classic bear flag or bear wedge pattern. Big down move, sideways consolidation. What's a bear flag? Essentially that, right? Big drop, sideways consolidation, which leads to another drop. Essentially, that's what you have here. Now, this is what I discovered yesterday. Check this out, guys. So this is a wedge pattern, bearish wedge. But let's zoom in here just a little bit. Let's do a classic zoom in. By the way, great stuff. What do you guys see now on this chart? All right. Now, again, some of you guys may not know. A lot of you guys are beginners. I'm here to teach you, to make you into essentially as much of a pro as I can. All right. So within that bearish wedge, this is a classic head and shoulder pattern, which has now broken down. Head and shoulders are bearish pattern formations. When they break, you take the highest point, drop a plumb line. That distance will be replicated more often than not to the downside. It actually goes off the screen. So you have a wedge pattern that's bearish on the bigger time frame, right? So if we zoom out here, okay, we have this bigger pattern. Okay, let me just get this back and get those off. So the bigger pattern is bearish, and this is something very important. And the micro pattern, so this is a bearish pattern, and the micro pattern, there's your head and shoulders right there.